All right. Good evening, good afternoon, or good morning, depending on where you are, and welcome to the last session of the International Macro History online seminar of this semester. Today, we're very happy to have Mark Carlson from the Fed board, who's going to give a talk on a forthcoming book of his on the young Fed, the banking of crisis of the 1920s, and the making of the lender of last resort. Before I give the floor to Mark, it's customary to remind the audience of the rules of engagement. We will let Mark speak for 40 minutes to present his case. I will only interrupt if there are clarification questions. If you have one such clarification question, please type it in the Q&A with, emphasizing that it's a clarification question. Otherwise, you're welcome to type in your questions as we go along, and then I'll do the best to paraphrase them and ask them, Mark, in the subsequent 20 minutes for discussion. At the end of the hour, we'll stop formally, but for people who are interested in continuing the discussion, we'll carry on for a further 15 minutes. Okay, Mark.
Great, thank you so much. I am delighted to be here. Thank you to the organizers for inviting me to present, and thank you to everybody who is attending to listen. I'm going to be talking about the young Fed, the banking crises of the 1920s, and the making of lender of last resort. As we mentioned, this is my forthcoming book, which should be out through the University of Chicago Press early next year. And this is part of a broader project to really understand how the Federal Reserve came to understand its own role as a lender of last resort, and how it shaped its thinking about how to respond to financial stress. Of course, the standard disclaimer applies. These are my views. They should not be interpreted as being those of anybody else at the Board of Governors or its staff or anybody else in the Federal Reserve system. So why do I look at the 1920s? Well, first of all, it was a challenging time in the banking sector. This was a period where there was a credit boom that was collapsing. This credit boom had started amid the World War I, and in the early 1920s is collapsing and putting enormous stress on the banking system. The Federal Reserve is brand new at this time, and so it's really a great chance to learn about how the Fed was forming its thoughts. And the policymakers understood that their job was that the institution had been founded in order to respond to financial market stress. And so they step in to deal with a range of situations. And these included actual bank runs, potential bank runs, long-term structural issues at key banks, potential disorderly collapses of regionally important banks. So the whole range of different experiences. And they step in, and so part of the goal of this project is to understand what did they do and how did they do it, but then more deeply, sort of why did they respond in the ways that they did, and what were their concerns, what were their both about why not to intervene, but also why concerns they might have had when intervening, and then to understand what sort of lessons that the policymakers took from these experiences, both in terms of things that they think went well, but also in terms of things they were dissatisfied with, and so how they changed their policies in response. And so what was sort of the learning process of the Federal Reserve during this period. And finally, I want to see if there's any lessons that we should learn today, both from the interventions themselves, but also in terms of this whole process of learning at an institution. So just to give you a roadmap of how I will proceed. So I'll start talking just briefly about the background of the 1920s. Then I'll spend some time talking about what the Federal Reserve officials said they were interested in doing when intervening, and then we'll look at some interventions to see what they actually did. And then we'll talk about the lessons. So these will be the lessons for policymakers, but then the lessons for us as well. And so here is the boom and bust of the early 1920s in a single slide. So you can see in the upper left what's going on with the prices of, here it's cotton, but similar, you can see similar charts for other agricultural goods such as corn or wheat or cattle. And you see that the prices that they reached toward the end of the graph in 1916, 1918 are really unprecedented. Like nobody in living memory had seen prices like this before. So of course the farmers want to expand production to take advantage of these high prices. And they're going to do that by borrowing from banks. And you can see this in the chart in the upper right, that the bank loans outstanding, there's an upward trend, but then there's a little kink as they start, loans grow faster during 1916 and 17. And banks are increasing this lending mostly by increasing their deposits and not increasing equity. And you can see in the bottom left that bank equity to assets is falling. So bank leverage is rising during this period. Now, of course, this boom does not last forever. Once World War I ends, demand falls and there's a return to a lot of workers to production, and the prices of all these agricultural goods falls. And so the farmers are struggling to make the payments on the loans that they had taken out. You can see from the bank chart, the banks initially respond by trying to provide additional credit to the farmers to help them get through this rough patch. There's an even steeper kink in the bank lending. But this doesn't work out. The prices remain low for quite some time. There's challenges in the agricultural sector, there's challenges in the banking sector, and the number of bank suspensions really starts to rise, especially at these vulnerable banks that are more highly levered. And you can see that the number of bank suspensions in the bottom right reaches levels that had not been seen before. You might see seen similar suspensions during some of the severe banking panics of the national banking era, but this in the 1920s is just happening year after year. And so a number of people have written about this cycle. There's Rajan Ramtarian and Jaromsky and Wheelock, who've done a fantastic job of explaining all of these different dynamics. The point here is really that this is just the backdrop for what the Federal Reserve is dealing with, and it provides a reason why they would have been concerned about losses of confidence in either individual banks or within the regional banking system, is that there were just so many problems in the banking system. So to understand what Federal Reserve officials were concerned about, I went back to the Fed archives and looked through the records of what they were saying. And not only was this interesting to me now, but it was of interest to policymakers at the time. And so the board sent out requests for information to a number of the reserve banks. And there's a lot of correspondence between those reserve banks and the board about how the reserve banks are responding to these stress situations. They mostly focus on things that went well. And so when I look at the interventions, it's not a random sample. It is a sample of things where people thought these were success stories. But still, those are very insightful to understand. There's internal memos. Several of the reserve banks were kind enough to share the minutes of some of their board of directors meetings. There's congressional testimony, there's speeches. There's a lot of conversation as the policymakers are thinking through what was going on at the time. And so that's what I want to draw on. And here are some quotes that illustrate what I think is really one of the most important tensions associated with Fed actions. So on one hand, central bankers are keenly aware of that they want to be lending to solvent institutions. They don't want to be encouraging moral hazard or taking credit risk. And so there's a quote first from Kansas, the Federal Reserve Bank of Kansas City, where they say, we're willing to do extraordinary things to help out these banks up to the point where we would be taking any risk ourselves, right? So they're sort of suggesting they're not willing to lend provide credit to banks that are deeply troubled or have a lot of troubled assets. The Federal Reserve Bank of Dallas is even more direct, where they say, any lending to a troubled bank is just going to allow them to become further extended and further levered, and we don't want to do that. Just shut them down. So that's one point of view. On the other hand, policymakers are very cognizant of systemic issues associated with what a lender of last resort has to do. And so there's a quote from the Federal Reserve Bank of Chicago where they say, there were times in situations where we needed to be very liberal in our lending, even taking on the possibility of significant losses ourselves. But doing so was necessary to keep business collapse here in the state of Iowa. And I don't want to try to suggest that there is, some reserve banks are following one philosophy and some are following another. Rather, it's that the facts and circumstances really shape what they're thinking, right? There are times when the Federal Reserve Bank of Dallas is adopting a posture associated with similar to the quote here from the Federal Reserve Bank of Chicago, when there are times when the Federal Reserve Bank of Chicago is following a procedure very similar to the ones articulated by, say, the Federal Reserve Bank of Dallas. So sometimes they're being very expansive, sometimes they're being very cautious in their lending. The point is I want to make sure that these policymakers are aware of the tensions and this sometimes the need to take one type of action versus having different sets of considerations. And that plays out in terms of some of the other things that they seem to be considering when discussing their interventions. So one was the role of management and shareholders. The Federal Reserve was much more willing to lend if they thought that the officers were prudent and careful risk management. They were also very willing to lend if the shareholders were willing to provide additional equity into the bank. That would have certainly helped address some of the moral hazard concerns. Federal Reserve officials are more willing to lend if there's serious concerns about contagion. And that could have been contagion in the form of confidence, both in the banks, but also in the Federal Reserve System. They were conscious that this was a new institution. It had promised to provide liquidity to banks. And if it was seen as failing in that task, they were concerned about reputation risks to the Federal Reserve System itself. They also were cognizant of the interbank connections and that certain banks were key liquidity providers to other banks, and so they were more likely to be willing to assist those banks in when those banks were in need. And finally, they were also quite aware that their actions could set precedents, could create moral hazard, and that if they provided extraordinary assistance to one bank, then other banks would be seeking similar support. So those were some of the thoughts that were on policymakers' minds. Now let me turn to some of the interventions where you can see how some of these things played out. One of my favorite interventions in this episode is what happened for the City National Bank of El Paso, Texas. And the backdrop for this episode is very much the agricultural sector. In this case, it was cattle rather than cotton, as from earlier. But you still have the boom and bust cycle. It is augmented in El Paso because Fort Bliss, which is located in El Paso, was a major staging ground for the U.S. Army for World War I. And so there was a significant buildup in the size of the base. There was a lot of additional business and residential construction in El Paso as people were providing support services to the base. But of course, then once the war ends, the base is downsized. The new residences that were constructed were no longer needed. Some of the businesses were going out of business because the level of activity in the city was diminished. So not only was the price of cattle falling, but there was a drought in the area. And so the stories that people who were looking at the community at the time are heartbreaking. It was the agricultural situation was dire. So I just want to make sure that everybody understands that there were real fundamental problems that people were concerned about. And their bank failures are starting to become more common as people are realizing just how bad some of these problems are. But there's a certain snowballing that's going on with respect to these failures. So there's certain ones are failing because of fundamental reasons, but runs start to become more common. People start to become more concerned about their ability to access liquidity. And then the City National Bank of El Paso starts getting into trouble. This is one of the largest banks in the city of El Paso, which is a regional financial center. This bank is very well connected to all the banks in the region. And both Federal Reserve officials, but also officials from the Office of the Comptroller of the Currency, which is the chief regulator of and supervisor of this bank, are convinced that the failure of this bank would precipitate a regional panic. The bank experiences a run in early January 1924. That run occurs on a Saturday, where there are normally shortened banking hours, and that those shortened hours are what enables the bank to make it to the end of the day and close at a normal business hour. But of course, everybody expects that once the bank opens for business on Monday morning, there's going to be a large-scale run. And so the bank has already been borrowing extensively from the Federal Reserve. It's already having liquidity challenges. So the head of the Federal Reserve Bank of Dallas rushes to the scene. He arrives in El Paso on Sunday. He immediately starts meeting with people. There were examiners on the site. This is, again, an $8 million bank. People are assessing the size of the capital hole, and they guess it's about $500,000. So there are negotiations between the banks, the Federal Reserve, as well as the community. And this is sort of key to, again, sort of understanding why the Federal Reserve might have been willing to step in. Right? So the community members, which includes other representatives from other banks, as well as some of the business clients of this bank, are willing to step in and provide support. And so they are willing to buy $300,000 of bad assets from the bank, which is essentially going to be a capital injection. The existing shareholders are willing to provide $500,000 of support. They don't have the money immediately available, and so they're going to look for some liquidity support from the Federal Reserve to get through the week. And the Federal Reserve agrees. So they are going to make a $500,000 deposit in the bank. That will be then repaid when new equity is raised from the bank. There's also collateral. There is a $500,000 of admittedly bad assets that the bank pledges to the Federal Reserve. And the Federal Reserve is also given a first lien on all the unencumbered assets of the bank should it fail. The examiners take out a full-page ad saying that, with this new injection and all these resources, the bank has been returned to solvency. So there's a public statement about the support that is being perceived, and a sort of a stamp of approval from the examiners. So the structure of the Federal Reserve liquidity support is unusual, to say the least. And so the Governor McKinney reaches out to the Federal Reserve Board and makes sure that they are okay with this unusual arrangement. And so this is one of my fun archival finds. This is the handwritten note from the head of the Federal Reserve Board to be taken to the telegram office to be sent back to Governor McKinney, where he says, basically, do whatever you is needed to do. We will back you. He can't get everybody together that night, but because it's early morning hours in DC. But he expresses firm support for whatever needs to be done. So the Federal Reserve provides liquidity. There's this capital injection, and the bank survives the run on Monday. Conditions are stable in the city, but they're not stable in the region, so possibly justifying the Fed's concerns about regional panic. It ends up, there's a bank run in Albuquerque 2 weeks later, and the Fed is airlifting cash using the planes at Fort Bliss to Albuquerque from El Paso. The bank does close in May. It doesn't cause a regional collapse. The people on the ground say that this was due to the fact that people kind of got used to the idea this was not a healthy bank, and everybody kind of expected that something was going to happen to it at some point. The receivership turns out to be a legal catastrophe. Some of the community members who invested were given sort of sketchy promises by the old shareholders. So there's lawsuits that are bounding. The Fed sort of works to extract itself from the situation and writes off $100,000 in losses. Although this relative to its exposure at the end of January, this is fairly small. The shareholders, the people who injected capital, probably take significant losses, but the depositors are probably better off because of this whole intervention. And so this is probably a mixed success, but it's certainly one of the most interesting interventions. So as opposed to that one, which is much more of a sudden liquidity need, the Stockyards National Bank is much more of a long-term structural problem. So this is taking place in South St. Paul, Minnesota. It's again connected to the cattle industry. The Stockyards National Bank, as you might expect, was heavily exposed to the cattle industry. It is well connected. Is a correspondent for over 400 community banks throughout the 9th Federal Reserve District. It provides liquidity to them, both in terms of making loans to them, but also in buying loans from these smaller banks and providing liquidity in that through that channel. It is experiencing, these correspondents would typically maintain deposit balances at the Stockyards National, but those banks are needing those funds back at home, and so they're withdrawing the funds. That's creating another liquidity drain on this bank. And there's clear solvency concerns, right? So it's problem assets are accumulating at this bank. So given the role that this played in providing liquidity support to a large number of other banks in the area, there are concerns among Federal Reserve officials that problems here will have ripple effects throughout the district. So they provide support, and pretty substantial support, for an extended period of time. Right. So this is a bank that has assets of about $5 million. So it's not very large, but certainly consequential in the dollars at the time. But the Fed's loans are going to peak at just under $2 million. Right. So the Federal Reserve at times is funding about 40% of the balance sheet of this bank. It is providing loans, double or triple the equity of this bank, and it is doing so for a period of over 2 years continuously. And so this is not sort of the sudden liquidity needs typically associated with a lender of last resort, but this is a sustained structural liquidity support. One of the reasons they're willing to do this is because of the engagement of the shareholders. So the shareholders are continually injecting new equity into the bank that is just used to immediately write off bad assets from the bank. And it is because of this continual engagement by the shareholders that the Federal Reserve is willing to continue to provide liquidity support. And as you can see in 1922, the discount window loans from diminished back to zero. The bank seems to be back on its footing and is quite successful over the rest of the decade. So a successful intervention. The third intervention I want to talk about occurs in Boise, Idaho. This is in late 1921. You have the same sort of things we've been talking about with the other interventions, right? A rising number of bank failures, some starting with clear solvency issues, but issues of runs and liquidity dynamics seem to be taking hold. And so the Federal Reserve takes action in a very interesting way. So it sets up what is referred to as a currency fund, which we should just think of as large amounts of cash. And so they ship $1 million in physical currency to Boise, and they place it at two of the largest banks there. And this cash is being custodied at these banks. It is not on their balance sheet. It is still on the balance sheet of the Federal Reserve. These two banks will place in the Federal Reserve's care equal amount of Treasury securities. So the Federal Reserve, those are again sort of still on the balance sheets of the banks, but the Federal Reserve is holding on to it just in case. There are Federal Reserve officials still on site, And should anybody actually need a loan and need to use some of that cash, they are authorized then to take any collateral that's delivered to them and extend a loan, discount window loan against that cash and just hand over the cash to the people. So the cash is immediately available for people to use. It can be displayed behind the teller windows of the banks that are holding it, but is just still the property of the Federal Reserve. It's a large amount of cash relative to the amount of cash typically available in Boise. And it is well publicized, right? So the newspapers throughout the state are indicating that this cash is on the way, even as it's still arriving in the town. And so this, again, is successful in stemming the concerns. And so there are no further closures, there's no further bank runs in Idaho following the arrival of the cash. So in general, these interventions seem to have been fairly successful. The Federal Reserve officials, when we sort of align what their concerns were in these particular episodes with what they said they were concerned with overall, you see that they are well aligned. They're concerned about potential spillovers, they're attentive to the condition of the bank, and they're attentive to the condition of sort of managers and shareholders of the bank. So again, I noted that the interventions that are discussed in correspondence tended to be the ones where there was success on the part of Federal Reserve officials. There were, however, costs associated with interventions. And these are discussed in a variety of other memos. So one cost that Federal Reserve officials are concerned about is dependence on the discount window. And so they collect statistics on the number of banks that have been borrowing significantly for long periods of time. And this is from a memo from September 1925. And you can see at that point, there were a number of banks who have been borrowing substantial amounts from the Federal Reserve continuously for more than 5 years. There were more that borrowed continuously for 3 to 4 years. And so this was a concern to Federal Reserve officials because they're concerned that they are undermining any sense of market discipline, and that they are concerned that they are allowing inefficient banks to persist that otherwise should have been closed or would have been forced to shrink and allow services to move to more efficient and effective banks. And there were losses that the Federal Reserve incurred. And so here is some of the losses that were incurred in the early 1920s. The timing is a little varied across reserve banks. Some of them operate on a sort of a cash flow basis. Some of them are waiting until they accumulate, have sorted through all the recoveries. But you can see that the losses at times overall were meaningful. These losses did tend to be concentrated in the reserve banks that were more connected to the agricultural sectors of the economy and where the problems were deeper. So not only were there losses to the Federal Reserve these losses, what they meant was that the Federal Reserve would pass on any extra income, its sort of net profits onto the Treasury. And so any losses that the Federal Reserve incurred did end up reducing the amount of money that was paid to the Treasury, and therefore was a cost for the federal government. So not only did the Federal Reserve incur losses, but the policymakers were aware that they were potentially causing losses to others. Right, so when the Federal Reserve provides loans on a secured basis, it moves higher in the capital structure than depositors, which are just general creditors of the bank. Moreover, the Federal Reserve tended to take better quality collateral, and as I guess prudent risk management would take more collateral when it was lending to a troubled bank. But what this meant is that the depositors who decided to exit the bank were able to get all of their money out, and the depositors who remained with the bank were then having to try to realize based on whatever residual assets that were at the bank, which could have been sort of the worst, least quality assets at the bank. And so those depositors, which tended to be the smaller and less informed depositors, could end up bearing the brunt of the losses that would result from the Federal Reserve's lending. So this was a concern by policymakers, and it was also raised by a number of the depositors of the failed banks, including some letters from veterans who had indicated that that a significant portion of their life savings had been depleted because of what the Federal Reserve had done in particular instances. And that is certainly not something that any policymaker wants to be in. So the Federal Reserve takes these, policymakers consider these costs, and they decide that they want to take what lessons they drew and how they should change their behavior. And they respond, importantly, by tightening up their lending policies. So the Federal Reserve Bank of Dallas is very specific about what it does. They're going to have conversations with the bank officials. They're going to do an internal analysis. The Fed staff is going to do an analysis of the bank's books. The Federal Reserve staff may go visit these banks and have conferences and discuss with those banks how they can better manage their liquidity. So clearly no bank would want its supervisor to be that intrusively involved in its businesses. And so that's going to increase the reluctance of banks to turn to the discount window as a source of liquidity. There were the Federal Reserve Bank of Dallas also makes some statements regarding its support for troubled banks, and it will cite the City National of El Paso as an example of something it does not want to ever do again. Right, so other banks are aware of the support that was provided to that institution, and they come to the Federal Reserve Bank of Dallas and they say, "Can you help us out in that way?" And they specifically say, "No, we did that once. We were not happy with how it turned out. We are not doing it again. So you are not getting support." There's also a general shift in tone among official communications. So there is a shift in the description of discount window lending from borrowing against short-term assets. So there's focused on short-term borrowing against assets. Right? So there's a shift on this from sort of the short-term being on the collateral versus the short-term being on the borrowing, emphasizing the discount window should not be used for these sustained periods of multiple years. And these policies were intended to foster a reluctance to borrow, and by all accounts, they were successful. And so this is discussed in the in the statements and conversations of the Federal Reserve policymakers. You see it show up in the writings, say of Keynes, where he talks about a shift in the policy of the Federal Reserve in 1926. And so, while I haven't found any statements from commercial banks about changes that they were seeing, if outside observers such as Keynes were able to observe this, it certainly seems likely that the bankers themselves were keenly aware of this change of policy. This increased reluctance to borrow is almost certainly associated with an increase in the stigma related to the discount window. Right? There had always been some concerns about it, banks being reluctant to be seen borrowing from the Federal Reserve because it might indicate they were stressed. But if the Federal Reserve is increasing the barriers and increasing these non-pecuniary costs of using the discount window, that would certainly increase the stigma associated with its use. So then, of course, there are the banking panics of the Great Depression that occur not long after this change. And the Federal Reserve banks do not seem to have responded to these problems nearly as aggressively as they did respond to the problems of the 1920s. And so this is where I get to speculate a little bit. I think that it was because of their experiences in the 1920s and the lessons that they were drawing. They were less contributed to their reluctance to lend into the panics of the 1930s. right? They were aware of the solvency problems that banks were experiencing in the 1920s and the problems that had created for the Federal Reserve. And problems of bank solvency were certainly present in the 1930s. And so even though there were large benefits, probably likely to have been large benefits from lending and arresting the panics, there were also likely have been large costs. And I think it's important to be cognizant of that. All right, and so what should we take away from this for ourselves today? So some of the lessons are related to interventions. So publicity is important. Seeing the lender of last resort take action has important calming effects. When stress is manifest, knowledge about access to the discount window is not enough. There are some great stories about banks that are Federal Reserve members, but they're experiencing a run. And so the Federal Reserve responds by shipping armored cars of cash, complete with police escorts and sirens wailing, and people in bright uniforms hauling bags of cash into the bank in order to stop the crisis. And so there's a clear manifest problem at the institution, and there's a response that is equally public in terms of the support. You have other situations where, such as with respect to Boise, where there was a general sense of unease, but it was not targeted at any particular bank. And so the Federal Reserve responded similarly by announcing, we're shipping a bunch of cash to the area. It's not being given, it's not a loan to any particular bank, but we are aware of the situation and we are making sure liquidity support is available. And so that's very public, but it's definitely sort of shaped to the relative, to the vagueness of the concerns. And finally, such as with Stockyards National, where there were outflows, but there was no publicly observable concerns about the bank and no runs. And so the Federal Reserve support was very quiet. There's no public mention of it anywhere that I've been able to find. And so that sort of public, the level of publicity associated with response, I think, is a useful lesson for us. It's very clear in these situations that insolvency and illiquidity interact. Lending decisions needing to be made under uncertainty. I think the agricultural aspect of this makes that very clear, right? So loans have to be, banks are in trouble in July. You have to make decisions about lending then. Nobody knows what the harvest is going to be in September, what weather is going to be like in August, yet you need to make a decision. And to me, this underscores the enormous value of having the FDIC on a receivership process to deal with troubled institutions. The third lesson we have today is about engaging private agents in solutions and interventions, and that the structure of the interventions is going to determine their willingness to be involved in terms of the ability to realize on any gains should the institution survive, and how deeply the losses that they might incur should the institution close. And then a final lesson is a little bit more, perhaps even a slightly larger picture. So it's about the need to be careful and holistic when drawing lessons from the past. And so Gordon argues that there would have been a panic in the 1920s if the Federal Reserve had not been there to provide liquidity support. The case studies that I reviewed are certainly consistent with that story. I'm convinced that there would have been a number of regional panics if the Federal Reserve had not stepped in to provide liquidity to certain key institutions. But it's also clear that there were costs to these interventions. And policymakers in the 1920s appear to have focused on the latter. And that's probably because they were very tangible, and providing an estimate of the size of the benefit was very nebulous. And so I think it's important for us to understand both the benefits and the costs today, and to acknowledge both. And I think it points to the value of studying economic history and sort of the detailed analysis that are done to be able to provide a real sense of what all of these of the costs and the benefits of historical interventions have been. So with that, thank you very much. And I look forward to whatever questions people may have.
Thanks, Mark. Thanks for keeping to time. Of course, you're preaching to the convert here, right? Arguing for the advantages of studying economic history, right? You don't really need to convince anyone here. So as people collect their thoughts, let me abuse the usual chair's privilege and ask you something. So in reading the paper you submitted, one of the things I noticed is the amount of legal and regulatory experimentation. Right? So, starting with El Paso, they did everything, right? So they imposed a massive bail-in on the shareholders, then a further write-off of bad assets with a wider community. Then they provided liquidity. I agree that economic history can be very useful, but could something like that be replicated today? Aren't there more regulatory barriers to do all sorts of things that they used to do and experiment back in the day?
So it's really important to be cognizant of what the legal structure is at the time and where things are today. So since that time, the collateral requirements have been changed a lot, right? Mm-hmm. So this happened in 1932 during the Depression, when they were really concerned about whether banks had enough liquid assets or assets that could be pledged to the discount window. They broadened the scope. There was a further broadening of collateral that could be pledged during emergency lending during the 1990s in the midst of the banking troubles and savings and loan crisis. And so I think the policymakers have certainly learned from these experiences as well and changed the legal structure to make it so that a similar situation would we wouldn't be constrained again. That said, I think it's really fascinating to understand both the legal and physical constraints in terms of providing liquidity. One of the things that the Fed has experienced during some of both 2008, and then again in 2020, is that when it wants to provide liquidity, like institutions need to have accounts that money can be placed into, right? So these legal and structural constraints are key in terms of a crisis response, and sort of understanding those constraints can really tell you a lot about sort of why some of the actions that were taken in the way that they were taken, and what the situation that policymakers are these constraints are real in terms of managing crisis intervention.
Yeah. Thanks. So Bill English has a question, and I'm going to let him ask it himself. So just allow him to talk. There you are, Bill.
Yes, can you hear me?
Yeah.
Okay. Mark, I was wondering if you've looked across reserve banks in the 30s. So the question is, did the reserve banks that had bad experiences with lending in the 20s, were they tougher in the 30s? People have looked across reserve banks in the 30s at different lending behavior. Does it correlate with what you see in the 20s? Or had everybody turned over by then, so it didn't necessarily matter what the experience was in the 20s?
So I was looking for that because I was curious whether that was the case. It does not appear to be. So the losses that appear to have been most severe at the Federal Reserve Bank of Atlanta and the Federal Reserve Bank of Dallas. And we've had lots of stories about the Federal Reserve Bank of Atlanta being very proactive again in the 1930s, lending in 1929, lending in Richardson and Truist have a paper about their strong lending in 1930. So they, even though they had losses, remained pretty open to responding strongly to crises. Federal Reserve Bank of Dallas is what appears to be tighten up some of the most significantly in response to their losses. And while I haven't seen it sort of the amount of information is both more dispersed and more voluminous. So trying to get a sense of what their thinking is in the 1930s is more challenging. But from what I have been able to glean, they remain very tight in the 1930s and are quite proud of that fact that they are not lending to insolvent banks during that period. So I was kind of expecting to see that 1920s experience would correlate very at the Reserve Bank level, but I don't. In these two cases, it does not seem to have been the case.
Okay. All right. So questions are quickly piling up, but let's see if I can be efficient in asking them. So there's a couple of more technical questions. I'll ask them in sequence, and you can ask her both. So the first by George Perendia. Would costs not be lowered if the Fed acquired directly stocks in the troubled banks? Would that be unacceptable? And then Hallie Manderson, did banks have to pre-position their collateral at the Fed?
So let me take the second one first. So banks did pre-position collateral at the discount window. You see some banks are just essentially just have a bunch of collateral there and just use the discount window almost as a line of credit. And so, they will sort of vary the amount. They are always, sometimes they will keep the same amount of collateral there. Sometimes it's 400% of their loans. Sometimes it's 200% of their loans, right? They will sort of vary their discount window loans, but they keep a lot of collateral at the Fed. So this collateral was, in general, had to be short-term acceptances or treasury securities. The Fed was not allowed to take equity as collateral. So that was when we talked about before about sort of legal constraints on what the Federal Reserve could do, that was that taking some sort of an equity stake in the bank itself or taking equities as collateral was not legally permissible. We see the one-off case in Dallas where this is sort of done, but that was sort of why it was legally called a deposit, because that did not need to be collateralized. They could take all these other strange things as sort of quasi-security, but this was sort of a hastily arranged situation that they thought was going to be extremely problematic. And so I don't think was something that they would have been, certainly not something they would have been comfortable doing outside of some sort of an extreme event.
Okay, thanks. Chris Colvin has two questions, and I'm going to let him ask them himself.
Hi, can you hear me?
Yeah.
Yes.
Brilliant. Okay, so I was wondering if there's a sort of a process of learning across the 20s where they try all these things and then they sort of center in or hone in on one method of dealing with these banks. Is there a sort of a process of learning? And the other thing was, do state chartered banks learn from what the federal level are doing? So that it's basically learning from each other and all that. I'm not sure I'm making any sense, but I'll stop speaking now. How do I press mute? Is there a mute button?
Yeah. So I think that the Federal Reserve officials are talking amongst themselves. They talk about their experiences. There's some meetings of the Conference of Governors, which is all of the 12 the heads of the 12 reserve banks coming together to talk about dealing with troubled situations. They just agree as a first principle is better to stop banks from getting into trouble in the first place is the first best solution. But they also really the lesson seems to be that, or the learning that most of them have is getting deeply involved in these troubled institutions is a bad outcome. And you want to really avoid lending into them, and you want to think about having an exit strategy for dealing with them. So you're not lending to a troubled bank for a long period of time. Right? They talk about, I think for a while, the Federal Reserve Bank of Dallas is like the fourth largest holder of cattle in the state of Texas. Right? They had taken so much bad collateral from troubled banks, and they really don't want to be in the cattle management business. They would like to be a central banker, and so finding ways of not having to take collateral, of really focusing on lending to solvent banks, is the lesson that they take from this experience. I have not found, I would love to know what the commercial banks think of all of this, but I know I have access to the Federal Reserve archives, trying to track down some of the discussions amongst the commercial banks. Maybe there's discussions in like the American Bankers Association meetings or the like that would be worth digging into, but I just have not had a chance to do that yet.
And on the second question, on the state chartered authorities learning from federal.
I think it's similar. It'd be interesting to study what their interactions were. I don't. Being involved, I don't know that I think state regulators are probably even harder to come by than official pronouncements by the commercial banks. So I don't have any information on how the state bank authorities are reacting to this.
Bill English has a follow-up. Did the Fed have authority to hold deposits at banks?
So I think the answer is yes. I think we still do it for making as part of certain de minimis. I think we hold de minimis amounts at commercial banks in order to facilitate certain payments to contractors and the like. I think in the case of this large deposit, the lawyers came to the conclusion that this was the least obviously legally prohibited approach to providing liquidity. Mm-hmm. So sort of it goes back to, again, like, it's in certain situations there's going to people, I think they included, there's a letter of support for this action from the people in the Treasury and from the comptroller of the currency, right? So that people are willing to let things slide in severe emergencies that I don't think that they could make a regular policy move to do.
Good. Enrique Jorge Sotelo from Barcelona. So he thanks for the talk and he looks forward to the book. His question is about monetary theory, right? In particular, the famous real bills doctrine. And he asks when this became a problem in the 30s and, of course, pervasive elsewhere. So you showed some variation in the interpretation of crisis interventions across different Federal Reserve banks, depending on specific conditions. Did you also see relaxations of these real bills doctrine criteria as well? Was there evolution in the monetary figure?
So it was really interesting to read the writings of some of the people at the Federal Reserve Bank of San Francisco. So they were some of the more prominent proponents of real bills. But they were also some of the most innovative and aggressive in dealing with certain financial stress events. And they talk in some of their memos that they send to the board. They talk about a national or systemic crisis, and how that is a very different event than sort of the run at an individual bank, or sort of what you might a prevailing philosophy for general implementation of policy. And so it was really striking to me that among a very conservative monetary policy central bank or reserve bank, that there was also this very extraordinary willingness to intervene during what they viewed as an emergency event, and sort of really separating the lender of last resort and what you needed to do there from a typical monetary policy. So I think it's worth keeping in mind that these thoughts were not what a reserve bank thought of in terms of its monetary policy approach should not necessarily be interpreted as reflecting its approach to emergency liquidity support.
Okay, so I'm going to unmute Caroline Follin, who I think has an idea for a follow-up. Caroline.
Oh, hi. Am I
Yes,
on?
great.
Okay.
Yeah.
So, as we were just discussing in Stockholm a few weeks ago about the Aldrich-Vreeland Act, there was the non-crisis of 1914, in which Ellis Tallman and others have argued the intervention of the emergency currency was important in preventing a crisis at the outbreak of World War I. And I'm just wondering if you can do a back of the envelope sort of hypothetical diff and diff with that situation in 1914. And maybe you actually have some archival evidence that you can turn up at that time, because maybe the Fed had already started, I don't know exactly what the nitty-gritty details were on that, but maybe it would be interesting to compare the more stripped down emergency currency program of Aldrich-Vreeland.
Yes, I'll have to think. It's an interesting comparison. Certainly we see episode, like I described in Boise, where they, shipping cash, making it available, which maybe certainly seems reminiscent of supplying physical currency via the Aldrich-Vreeland, and some of the policymakers like Charles Hamlin, who was involved in helping some of the reserve banks, or was involved in helping distribute Aldrich-Vreeland, was on the Federal Reserve Board as a early member. So there was certainly that knowledge transferred over in terms of the policymaker expertise and awareness. I'll have to think about that. That there's definitely a sort of continuity of some thinking between the two.
And the asset backing, the different assets, that very broad range of assets that were allowed under Aldrich-Vreeland for backing the currency. I just wonder if that's different, or in other words, was the Fed a continuation of very similar facility?
I mean, certainly in some ways, right? The fact it's not necessarily, does not have to be government securities. They were allowing private assets in the way that Aldrich-Vreeland did. So different types of non-U.S. Treasury collateral, but definitely that's thought is there. Yeah. Yes. I have to think about that.
Great. Let me just interrupt and say that we came up to the hour. So for people who have to leave now, thanks very much for attending these and the other seminars in the series. Of course, as I mentioned, you're very welcome to continue to carry on for extra time and for the continuation of our discussion. There are a couple of questions I still want to ask. But for now, if you have to go, thank you very much. This is the end of this semester series, but the good news is that we restart on February 12th. And I can announce already that the first talk will be given by Warren Watley from the University of Michigan on slavery, freedom, and development, how Africa became the mirror image of Europe. So until then, happy holidays, and may 2025 be a happy one for everyone. All right, and now seamlessly we carry on. So I am going to unmute Eric Monet this time, so he can ask his question. Eric?
Yes, I'm sorry, I have to leave.
Oh, okay.
Oh, I just so just see you, Mark, and I really have to rush.
Okay. I'll ask the question for you, and you can watch it later. So, how did the 1925 financial reforms, namely the Agricultural Credits Act and the Fed new guides to credit policy, respond to these events?
So I think the short answer is I'm not sure. I'll have to go back and think through. I did not see a lot of discussions of this in terms of the approach to lending that among the Federal Reserve officials. They're certainly aware of all the changes being made and pining on them generally, but I don't know that they made too many changes in the lending policies in response to those.
Okay. Richard Silla, I think he's still around. Yes. Richard, do you want to ask your question?
Hi, Mark. The question I have is I read a book by Jim Grant on the recession of 1920-21, and he makes the argument in that book that the recession cured itself without any significant public policy interventions. And I just wanted to ask you, I think I know what the answer will be, but I think I wanted to ask you, do you agree with Jim Grant?
So no, I don't necessarily agree with that. So I mean, I think there was a monetary policy easing, which supported the recovery, and I certainly think that the Federal Reserve response to the distress in the banking system was very important in keeping the financial sector from falling apart, experiencing even deeper troubles than it experienced. Had there not been this sort of support, that there would have been a more serious banking crisis and probably an even deeper recession than there was. So that is, yes, I think that the public policy response was a key in terms of managing the 2021 recession.
Good. So Bill English has another follow-up. Bill, do you want to ask it?
Yeah, sure. I was just thinking what you said about the South St. Paul Bank. So the Fed lent them $2 million for 2 years. They then got through and they were fine in some sense. So I guess the question is, if the Fed weren't there to lend them $2 million, were national money markets big enough? Could they have gone and borrowed $2 million from some private source, given that their correspondent banks were drawing money out of them? So they had to come up with the money. Was there any other way that they could have done it? If they were unquestioned, could they have come up with $2 million?
So I think I don't think so. I think that would have been a lot of money for them to borrow. Like certainly the Chicago or New York banks would lent a lot of money to sort of the other intermediaries in some of these regional money centers, but I don't know that they would have done it for a sustained period like that. The other large banks in Minneapolis and St. Paul were also borrowing fairly substantially from the Federal Reserve Bank of Minneapolis, and they were doing what this bank was doing, but not to the same degree. But they were definitely also reliant on the support from the Federal Reserve Bank of Minneapolis, and so they would not have been in a position to be able to provide liquidity support to this bank that they probably would have known reasonably well. And I think that to me highlights the systemic nature of what was going on in 2021, that there were, that the banking system as a whole needed liquidity, and so some sort of broad, expansive policy by the Federal Reserve to provide liquidity generally was required. I have to think hard about whether sort of an open market operations would have been sufficient, but I think this sort of the structure of how those funds would have needed to make their way to the system would have made it less. I don't think it would have had the same beneficial effect that liquidity support was provided to the discount window did.
Okay, Nathan Sussman has his electronic hand raised. Nathan.
Yeah, hi Mark. Thanks for the presentation. So I was going back to one of your slides about where you kind of total or report on the Fed losses from all these interventions, and to what extent there was a discussion at the time about these losses. I mean, were they public? Were there was some discussion in the board about because I think in the recent period there are all these discussions about recapitalizing central banks and whether central banks can be I mean, so were any of these discussions back then, or was the public involved, Congress or some other authority, or was it completely under the radar?
So let's see. So there were certainly discussions within the system and a lot of hand-wringing about these losses, and that they were not happy with that particular outcome. They were not made public. There were all these reports were internal. A lot of the accounting statements in the public. These costs end up being buried with other costs of this system. They're not disclosed. There's hearings with the agricultural inquiry at Congress. I don't necessarily know that they discuss the losses there, but most of the legislators are coming down on the Fed for not being aggressive enough in terms of lending and providing liquidity to the banking system. So I guess in that sense, they were not, there doesn't seem to have been, public condemnation of doing too much and lending too aggressively. I think on the contrast, it was not doing enough, not lending aggressively enough. I don't know if they would have realized that would have resulted in losses, but there wasn't. Doesn't seem to have been a lot of concern about the Fed taking too much risk in its activities from that part of the policymaking sector.
Thanks. Rui, you're muted.
I was about to say I'm not seeing any further questions on the queue, so last call for anyone who wants to come in. If not, it's not by design that we end up having a talk about banking regulation and lender of last resort close to Christmas, but I guess this is the wonderful live seminar slot. It's not the first time, actually. So on that note, again, thanks a lot, Mark, for bringing your paper and your book. We, of course, look forward to see it in print. And again, happy holidays to everyone and great entry into 2025. So thanks a lot. Thank you.
Thanks a lot. Happy holidays.
Bye-bye.
Bye.
Bye-bye.